The system is long in the tooth. Friday is the 54th anniversary of when Nixon uh, uh, closed the gold window or suspended the convertibility of the dollar into gold temporarily. And it's been a massive increase in debt, financialization, derivatives. It's all mushroomed so much that I think these guys know as well that you can't keep this going forever. And I think they do want to bring in some kind of digital currency. The Europeans are more into the CBDC. In the US, it seems to be more through the private sector and crypto. And I think crypto has been kind of an experiment. It's been portrayed as a grassroots movement to fight the bankers actually in their system. Who they are, I guess it's the bullion banks, and they work for the central banks, basically. I think the central banks are involved, even though they don't hold much silver. And I think they don't like silver up so much because if you look at historically, silver, even up until the early 70s in some European countries, they're still using silver as money, coinage. And in the US until 1964, Switzerland till 1967, I think. In the UK, we got off silver a bit earlier. It was 1947 because the UK was bankrupted really by two major wars. But yeah, and I think they don't want the public to get involved in silver because it's kind of in our DNA, and loads of words, words for money in different languages is silver. Like in French, it's argent. In Spanish, it's plata. And even the word dollar comes from the Spanish mil dollar, which came from the Joachim's Thaler silver coin. So I think that's why they're concerned.
Silver's legacy as currency spans millennia, from Latin plata to France's argent, and still echoes in words like dollar. Up through the 1960s and 70s, many Western nations issued coins with significant silver content. The UK dropped it post-World War II, the US in 1964, and Switzerland in 1967. That legacy fuels emotional resonance. People instinctively recognize silver as wealth. For some powerful players, managing that narrative and preventing a resurgence of public trust in silver is a subtle priority. Today, rising industrial demand and speculative appetite are revisiting silver's dormant monetary symbolism.
And a lot of times, they also want to maintain the market volatile because that puts a lot of investors off. They want to make it so that it's just like a volatile commodity. And that was one of the strategies that they basically installed when they, let's say, when the US allowed gold to be legal again on 1st of January 1975. There's a WikiLeaks document where the Treasury and the Department of State communicate with bullion dealers in London, and they say, yes, it's good that we're going to have a futures market for gold because it's going to keep the markets very volatile, and it's going to keep the public from demanding physical gold. And it's the same thing for silver. And I don't think they're going to make it, though, because the debt situation is so out of control that I don't think the dollar or all the other fiat currencies have much time left. And I think they know it, these bankers, even though Ben Bernanke seemed to play dumb when asked what gold was by Ron Paul. He said it was an addition. So that's why they try to keep things like under wraps, under control. But the bankers might You can't count them out. They might even reverse their short positions and go long silver. Who knows? They usually end up doing really well no matter what happens.
Electronic futures trading has transformed precious metals pricing. Since the mid-2000s, trading shifted off the visible floors into anonymous digital systems, allowing large players to hide identities behind orders. Practices like spoofing, placing then withdrawing fake buy or sell orders to manipulate sentiment, have been used and fined. Fewer eyes see trades now, meaning coordinated large orders can shift prices sharply, especially in silver, where contract depth is shallower than gold. While some banks claim these are mere hedges, many industry experts remain skeptical, citing years of observed behavior and regulatory leniency.
I worked in the futures market for like 20 years, mostly government bonds and interest rates, but I got involved in other kinds of futures. And I can tell you that someone comes with a big order, they can move the price quite sharply. And especially in silver, because silver is not really a very deep contract, as deep as gold and other futures markets. So these guys know the price levels, the supports and resistances. And when the market gets too frothy, they'll come in and sell like 1,000 futures of silver, which is big. Prior to, let's say, the early 2000s, it was a bit more difficult to manipulate the futures market because all the trading was done on the floor and people could see who was doing what. You could see if JP Morgan or the broker that JP Morgan used was selling or not. But the market went electronic basically by 2004 or 5 or thereabouts. Futures were all traded electronic. So they can hide behind that because when you sell or buy on the screen, it doesn't show who's doing it. And the other thing they've done and they've been fined for doing is spoofing the market. That means you put a huge offer on the screen and then you pull it. But the reason you put the huge offer is to scare people off from buying, and it actually might trigger some selling. The people in the bullion banks, they say that they don't really go short. It's all hedging. But I think, I don't buy that. And I think a lot of times they also front run their big clients. If a big hedge fund comes and tells a bullion bank, I want to sell 1,000 silver contracts, they'll sell as well.
The axis of precious metal exchange is tilting eastward. In early 2025, COMEX saw a historic surge of 81.2 million ounces of silver deliveries, the highest monthly volume since 1933, and inventories may deplete within months under the strain, Discovery Alert. Meanwhile, London's LBMA vaults recorded gains. Gold reserves rose 0.6% and silver 3.3% in April 2025, Discovery Alert. Against this backdrop, physical settlement and the ability to deliver is under pressure. Exchanges can, in theory, halt deliveries or force cash settlements, actions that might preserve credibility in the short term, but risk long-term trust.
And then, when I worked as a futures broker, I always tried to work the orders so I wouldn't move the market in a prejudicial manner for my client. And that means, if he gave me a big order to sell something, I would work it. I wouldn't try to smash the price, but that they do, and they seem, back in 2021, that's what they did when we got up to 30. And even the head of the CFTC came out and said, well, we had to tamp down the demand, they basically smashed the futures at the 30 level. And it kept silver from rising for like 3-4 years, really definitively. So that's what happens, and it happens in gold as well. It happens in other markets too, but when it happens in other markets, the regulators really come and clamp down on the people who do it. But with gold and silver, it seems to be rare that the regulator does anything. If anything, they do it when the market is going up a lot, just like we saw with the Hunt brothers in January of 1980. They banned people from buying silver futures because they lost control of the market. So that's the CFTC. They're not there to they're there to protect the bankers, these regulators.
Central banks across emerging markets continue buying precious metals to shield against financial instability. In Q1 2025 alone, they added around 244 tons of gold, well above historical averages, World Gold Council. Russia and China are key players. Bilateral gold and silver trade surged 80% year over year to roughly $1 billion in H1 2025, Discovery Alert, Bloomberg.com. China's reserves now officially exceed 2,200 tons, though analysts suggest actual holdings may top 5,000 tons, MarketWatch A Invest. Such accumulation is part of a broader de-dollarization trend, not just a hedge, but a pivot away from Western monetary levers.
Recently, I spoke to David Jensen, and he said that on the LBMA, platinum right now, there's almost no physical platinum in London, but they still trade like the equivalent of 3 million ounces daily. So as long as people don't ask for delivery, this kind of, it's like a bucket shop. I don't know if you know the term, like Jesse Livermore used to.
Different Livermore, yeah.
Yeah, he used to bet on the prices, and that's basically, and he didn't actually receive the shares when he did that. And that's basically what these gold and silver markets are. The gold and silver markets run by London and New York, the banks. In my opinion, they're bucket shops. And yeah, one day, someone big will ask for delivery, and like you saw earlier this year in January, the spot settlement for the LBMA gold was 4 to 8 weeks. Basically, they didn't have the gold to deliver. They said it was too heavy and they had problems moving it. But the other thing, Andy, is that they can always just close the exchange and declare force majeure, or say that they have the wherewithal to change the rules and say you can't have the silver or you can't have the gold. You get cash settlement. So that is possible, but then they'll lose a lot of credibility as an exchange. And I think that's happening on COMEX and LBMA as well. And I think the price discovery mechanism is moving more and more towards the east. By that, I mean like Shanghai, Hong Kong, even Moscow, they have physical exchange. And I think they've opened another one in St. Petersburg, Dubai. So that's the way I see things going.
Precious metals are breaking from obscurity into mainstream appeal. In 2025, silver is up nearly 25%, gold similarly climbing, with forecasts hinting at even higher targets as interest rate pressures ease, Sprott, Metal.com. Peru's gold exports to China have already surpassed all of 2024, highlighting booming demand amid geopolitical tension, Reuters. Yet unresolved questions loom. Can markets sustain delivery demands? Will exchanges endure if physical settlement overwhelms paper trading? As digital currencies and CBDCs emerge, gold and silver remain essential anchors. Whether hidden forces accelerate change or the public reclaims its shine, only time will tell.
The system is long in the tooth. Friday is the 54th anniversary of when Nixon closed the gold window or suspended the convertibility of the dollar into gold temporarily. And it's been a massive increase in debt, financialization, derivatives. It's all mushroomed so much. that I think these guys know as well that you can't keep this going forever. And I think they do want to bring in some kind of digital currency. The Europeans are more into the CBDC. In the US, it seems to be more through the private sector and crypto. And I think crypto has been kind of an experiment. It's been portrayed as a grassroots movement to fight the bankers actually in their system. But now all the bankers and even the Trump administration, they're getting involved. So it's been hijacked, or maybe it was created by them to use it as a solution to the collapse of fiat. And I think they do need gold and silver if they want to get back up and running, because if you just bring in not fiat, but if you bring in digital currency or CBDC with no backing, with just the same old, let's say, government debt backing, I don't think that will work. So they will have to resort to some kind of commodity money. And I think the BRICS countries, especially Russia, China, and other countries, they've been buying a lot of gold since 2022, and because they see the writing on the wall.